Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this FR exam practice session. Now my friends, for this time I have opened the mock exam on CB practice platform. We are going to attempt this mock exam for December 23. We are going to attempt the whole exam and we have to make sure that we do it within time, and if we do it within time it will only be useful. It is possible that while I'm doing this mock exam, I'll be explaining some things to you, and therefore I may take a bit more time on a particular MCQ or MTQ as compared to what you would have in your real exam. You need to discount that while you are attempting, such an examination by yourself. So without any further ado, I'll just begin and I'll start with section number A of the exam. Now, my strategy always has been to follow the examination pattern as is. So what I would be doing is I would be doing section A first, then section B, and then section C. That this is what my personality suits to. If I were to go in an exam in nowadays, I would have done the same. It's all on you how you want to attempt it. Let's start with it. Now there is MCQ number 1, which says which two of the following statements are true about the guideline and content of the conceptual framework for financial reporting of the International Accounting Standards Board. Now this question pertains to the conceptual framework issued by the International Accounting Standards Board, and let us just see which two of the following can be correct. It says that the principles contained in the conceptual framework cannot override the accounting treatment of any IFRS accounting standard. Yes, if there is a conflict between a particular IFRS and conceptual framework, IFRS prevails. So the conceptual framework cannot override the IFRS. This is true. The conceptual framework states that information must be relevant and comparable in order to be useful. No, there are two fundamental characteristics defined in the conceptual framework, and that is one, relevance, and the other one is faithful representation. So this is not the correct answer. Comparability is an enhancing qualitative characteristic, not a usefulness characteristic or a fundamental qualitative characteristic. Sorry, the conceptual framework is not an IFRS accounting standard. True. This is true. The conceptual framework uses a rule-based approach rather than a principle-based approach. That is purely incorrect. Now, the ISB's methodology towards doing financial reporting is always principle-based approach. None of the accounting standards or the conceptual framework defines any rules which you must follow in each and every circumstance. So IFRS rather follows the principle-based approach. You have learned about the prudence principle, the matching principle, the consistency concepts, and the accruals concepts, and so on and so forth. These are all principle based approach rather than rule based approach. So this is incorrect again. Yeah, we'll move forward. Question number 2. Delsey Company is considering the following potential assets for inclusion in its statement of financial position. Indicate which one of the following should be recognized as an intangible asset. A brand name developed by Delsey Company worth $10 million. Now, if Delsey Company has developed a brand name internally, it is part of your internally generated goodwill. So, it is unlikely that in any circumstance, IAS 38 would allow you to recognize an internally generated intangible asset. So this should not be the answer. 2.5 million spent on new equipment to develop a new successful project. Now, if you're spending money on a new equipment, this is a tangible asset, and whatever tangible asset you have, it does not come within the scope of intangible assets IAS 38. So this cannot be the answer. B cannot be the answer. $3 million acquired to paid to acquire the brand name Legends. Yes, this is true. If intangible asset has the condition under IS 38 of identifiability. An intangible asset is supposed to be identifiable if its cash flow can be distinguished from your other operations, or if you can say if the asset has the capability of being used or sold, independent of all other assets of the company. So that is identifiable. Or if the intangible asset has been acquired as a result of contractual relationship, that also comes within the purview of IS 38. So C should be the answer. $0.5 million spent on training to operate staff new equipment, that can neither be a tangible asset nor be an intangible asset. So I would say that C is the correct option. Moving forward. Orange acquired 12,000 shares in Red Company on 1st June X5. So the company has acquired 12,000 shares in Red Company on 1st June X5 at a cost of $8.10 per share. Now, in a real exam, you will have a worksheet available with you on which you can write down these important particulars. But what I am going to do right now is I have, prepared an Excel file. And this Excel file is in front of you. I'll be noting down whatever information I want regarding any MCQ, and we'll be solving on this Excel. Yeah, this is the third MCQ that we are doing. So Orange Company has acquired 12,000 shares in Red Company at a cost of 8.10. So 12,000 shares have been acquired at a value of 8.1. So this makes the total value of 97,200. Then it says Orange Company incurred transaction cost of $12,000 for this purchase of shares. Now you know that this transaction cost shall be capitalized logically, but you need to see which model they are using. You see, under IFRS 9 you have two approaches to deal equity investments with. Either you can deal it under FAOCI model, or you can deal it within FVPL model. In FVPL model, these shares are held for trading. So any cost that you incur or any gains or losses, unrealized or realized that you have, they all go in P&L. Whereas under OCI model, everything goes into OCI or the transaction cost is capitalized. Orange Company elected to measure the shares at fair value through other comprehensive income. That means this $12,000 worth of transaction cost needs to be capitalized. So I'm just going to write down here, just giving a bit of space for myself, cost of shares. This was the cost of shares. Yeah. Then there is transaction cost of $12,000. So the total cost of shares should be 97,000 plus the 200 plus 12,000. This is the total cost of shares. Then moving on. At 31st December 20x5, the fair value of the Red Company shares had fallen to 7.80 per share, and the selling costs were expected to be 5.0. Now you know that at each reporting date, doesn't matter if you're following FVOCI or you're following fair value through P&L model, in each of the models you should be fair valuing your investments at each reporting date. Now how many shares do you have fair value at reporting date? You had 12,000 shares with you. Yeah. Now these were with the price of 7.80. Remember, you do not take fair value less cost to sell. Rather, under IFRS 9, you only take fair values of shares. So this is 7.80, $12,000 into 7.80. This comes a reporting date value of 93,600. Examiner asks you, how is the investment in Red Company shares measured in Orange Company's separate statement of financial position at 31st of December X5? So the question is that how should Orange Company show its investment in its separate financial statements? So the investment must be shown at fair value. And this fair value would be 93,600, which we just calculated. Yep. So done. Let's move on. On 1st April 20x4, Watch company acquired 65% of fellow company's ordinary share capital. So one company has acquired 65% shares of another company. That means 65% is yours, and the NCI, the non-controlling parties, should be 35%. The fair values of the net assets of fellow company at the date of acquisition were equal to the carrying amounts, with the exception of a provision which had a carrying amount of $35,000 below the fair value. Now the provision had a fair value of 35,000 below the fair value. So technically it is a downward fair value adjustment for a liability. It is a downward fair value adjustment for a liability. Examiner says, watch company elected to measure non-controlling interest at acquisition at fair value. Examiner says, what is the impact on goodwill at acquisition of the fair value adjustment required in respect of the provision? So you see, principally, we are talking about MCQ number 4. This is a downward fair value adjustment on provision. So the provision basically had a $35,000. The provision's value, fair value, was $35,000, below the carrying amount. Now, this is a very interesting for you guys to understand. It's clearly written that fair values of the net assets of fellow company at the date of acquisition were equal to their carrying amount. First of all, you need to understand it till here. Now, the sentence written till here is pretty much normal. It's nothing new. But then it says that with the exception of a provision which had a carrying amount of 35,000 below the fair value. I misread it myself. It seemed to be, you see, in normal section C questions we used to attempt in our regular classes, we always used to have this line that the fair value was less than by X amount as compared to the carrying value. Now it's written the other way around. Your carrying amount of liability is below the fair value. So that means that fair value was higher than the carrying amount. It is an upward fair value adjustment. I read it wrong myself. Now, this is a mistake that you could do even yourself. It is a 35,000. The carrying amount was 35,000 below the fair value. That means fair value was higher, carrying amount was lower, and the amount was 35,000. Let me rephrase myself. This is supposed to be an upward fair value adjustment on a provision. So the accounting entry should be that you should be crediting your provision, since you need to increase your provision's value. Provision credit 35,000, and you know guys, that anything that happens on the acquisition date impacts the goodwill. So the entry should be goodwill debit 35,000 and provision credit 35,000. Your answer should be, what is the impact on goodwill at acquisition? It should be 35,000 increase. Yep. Moving on. Which two of the following statements are correct in relation to intangible assets? This is question number 5. IS 38 requires, please note this down, it says requires. Now I'm very much thoughtful in any exam. Whenever I see in a particular MCQ or MTQ, I see the word requires, I get very cautious, because sometimes, IS and IFRS provide a principle that you may apply this approach, but whenever it's written required, it's a mandatory thing to be followed, and you need to be very careful while attempting such MCQs. IS 38 requires the revaluation of intangible assets where a company has chosen to apply the revaluation model to property, plant and equipment. This MCQ provides for that according to IS 38, if a company is applying revaluation model in IS 16, that you must be applying the same model in IS 38 as well. And that is not true. IS 38 has its own approach. For example, IS 38 says that revaluation model for intangible assets is only applicable when, for example, there is an active market for intangible assets and you are able to revalue your assets, on a very consistent basis. Now, the case scenario must be different for tangible assets like property, plant, and equipment, where usually an active market exists. But for intangible assets, it's almost the other way around, because often there is no active market for intangible assets, and therefore no accounting standard can require you to follow revaluation model. It's not a requirement. It may be It may be from a consistency and comparability point of view, it may be a recommendation. It's definitely not a requirement. Then a change to IAS 38 revaluation model from the IAS 38 cost model is a change in accounting policy that is accounted for prospectively. Now, I know that you guys already know that according to IAS 8, all accounting policies are applied with retrospective effect. So you apply your accounting policies retrospectively. Now here your examiner says that if you switch from revaluation model to cost model, it is a change in accounting policy that may be accounted for prospectively. And actually, yes, this is true. If you have read IAS 8 very carefully, IAS 8 provides for this fact that the changes in accounting policies must be applied retrospectively until and unless it is not practicable to do so. If it is not practicable to apply an accounting policy retrospectively, then you have no choice but to apply an accounting policy prospectively. Now, for intangible assets, this is true, because if you are switching from cost model to revaluation model, you might not have a ready-made available market value for your intangible asset for previous years. You might have fair value for now, but you may not have fair value of intangible assets from previous periods. So the only logical thing to follow in the case of intangible assets will be to apply your accounting policy change prospectively rather than retrospectively. I mean, this is one of the exceptions of IAS 8, and this has been mentioned under IAS 38 as well. So yeah, good knowledge for us. This is true. IAS 38 permits the revaluation of intangible assets only if there is an active market for such assets. This is true. So B and C should be the correct answer. IAS 38 requires that the initial recognition of intangible assets is at fair value. This is totally wrong, because the initial recognition of intangible assets should be based on cost, not at fair value. So we have spent a lot of time on this MCQ, but at least we now know the learnings. B and C are the correct answer. Let's move forward. We'll go with MCQ number 6. On 18th of July 20x3, yeah, this is before the year end. Your year end is 31st of December x3. On 18th of July x3, Gomer company commenced work on the construction of a significant asset for one of its customers. Construction is scheduled to run for 2 years. This gives us the idea that it is a point over time contract. You are constructing something for your customer. It should be a point over time contract, and you should be recognizing your revenue according to the stage of completion over the period of time. Construction is scheduled to run for 2 years, and the total contract price is $80 million. At 31st December 20x3, the following details are obtained in relation to the contract. The contract was assessed to be 50% complete. Now, if the contract is 50% complete, then the revenue to be recognized should be 50%. Yeah. So I'll just write it down here as well. This is MCQ number 6 only. Revenue to be recognized. Revenue to be recognized should be, the contract value was 80,000 or 80 million, and I will multiply that by 50% because 50% revenue should be recognized. I'll just change the formatting of this a bit so that you can see the numbers. $40 million that you see. The amounts invoiced to customers total 27.2 million. Amounts received from the customer is 12.8 million. Invoices are raised and settled on a quarterly basis. Your examiner requires you to answer what is the total amount that would be included in the statement of financial position as at 31st December 20x3 as a contract asset for the construction year. Now you need to determine the contract asset, or in the other case it would have been a contract liability for your for this particular contract. Now according to IFRS 15, the relevant format to be followed nowadays is that you take your revenue to be recognized and less any progress billings, not the amount received from customer, but the progress billings to date. If the progress billings are less than the revenue recognized, then you'll have a contract asset. So what is the progress billing to date? The progress billing to date is amounts invoiced to customers total 27,200. Total 27,200. So this 27,200 should be subtracted from here, and you will have a contract liability, contract asset of 12.8 million. So the answer should be 12.8. Done. Very easy. This is the step number 4 that we studied in point overtime contracts. Let's move forward. On 1st October, this is the MCQ number 7. On 1st October 20x5, Bermuda Company issued an 8% $60 million convertible loan note at par. Now, we already know how we deal with convertible loan notes, and I'll just give you a recap how we used to deal with convertible loan notes. This is MCQ number 7. For convertible loan notes, we used to calculate present value of all future cash flows, and that used to be your debt component. We used to compare that debt component with the consideration value to get the equity option, the equity component. Yeah. So this is Bermuda Company issued an 8% $60 million convertible loan note at par. It is redeemable on 30th September X8. 30th September X8 means from 1st of October X5 till X6, this is 1 year, then X7, this is 2 years, and then till X8, this is 3 years. So you should be calculating present value of future cash flows for the debt component, and that will cover interest for year 1, then interest for year 2, then interest for year 3, and then principal amount for year 3 again. The interest amount would be as follows. This is a $60 million convertible loan note with the 8% coupon rate. So this should be 60,000 into 0.08. You'll get you'll have to make 3 interest payments in 3 years. Then there will be a principal repayment of $60,000. You need to calculate present value of these items. Therefore, you will be requiring a discount factor here. We'll just see for it. Yep. And then you'll get the present value. Okay. Let's move forward. It says it is redeemable on 30th September 20x8 at par, or it may be converted into equity shares of Bermuda on the basis of 100 new shares for each $200 loan note. Interest is payable at the end of each year. An equivalent loan note without the conversion option would have carried an interest rate of 10%. This is, my friends, the effective rate, 10%. The present value of each $1 receivable at the end of each year based on the discount rates of 8% and 10% are. These are the discount rates provided to you. You know that we use the effective rate for a discounting. So the relevant discount rate should be 0.91, 0.83, 0.75, and for the third year it is 0.75. Again, you could have done it through the annuity rate as well. You have been given the cumulative rates as well. It's your choice how to do it. Your examiner is asking you what will be the finance cost in statement of profit or loss for the year ended 30th September X6. What will be the finance cost for the first year? Now you can only calculate the finance cost for the first year once you know the debt component out of the convertible loan note. So the debt component should be the present value of all future cash flows. I've applied this multiplication formula in each of the cells, multiplying your cash flows with the discount factors, and here you get the debt component. This should be a sum of all future cash flows, which is 56952. And obviously, we know that if we compare it with the consideration received, which is $60,000, this will be the equity option. 60,000 into 56952, the difference is equity option. Now, we only need to calculate the interest component for year 1. That is to be recognized in P&L, interest expense. Now, interest expense is always recognized according to the effective rate. On debt component. And how will you do this? The debt component is 56952, and the effective rate, if you can see it here, it was 10%. So simply 5695.2, you can write this down. The whole figure would be 5695,200. I don't know. The answer should be 5695. Yeah, 5695 should be the answer. It's written that you should be writing your answer to the nearest thousand. So 5695 should be the correct answer. Yeah. Let's move on. Okay, so Jora company has decided to apply the revaluation model to properties for the first time from 31st December X6. Very good. At this date, details relating to its two properties were as follows. Now you have been given the carrying amount and the fair value for head office and factory. Head office had a carrying amount of 50,200, fair value of this. Factory had a carrying amount of this and a fair value of this. Examiner asks you what is the total gain to be recognized as a revaluation surplus in other comprehensive income at 31st December X6. This is the requirement. Yeah. At 31st December X6. Okay. Now let us just go on to our Excel and work this out. So we have MCQ number 8. We have two type of assets, head office and the other one was factory. Yeah. We had some carrying value and then we had some fair value. Yeah. Carrying value and fair value. And then we will have some revaluation impact. Okay. So the carrying value was 50,200 for head office, whereas the fair value was 50,900, 50,200, 50,900. And then about the factory, you had a carrying amount of 31,500, whereas the fair value was 31,300. Yeah. The revaluation impact for head office, the fair value was 50,900, whereas the carrying value was 50,200. So it is an upward, revaluation. It is an upward revaluation. For an upward revaluation, the accounting entry is always head office debit 700, whereas your revaluation surplus, your revaluation reserve or an OCI would have been credit 700. Yeah. About your factory had a fair value of 31,300, whereas your carrying value was 31,500. This means that there was a downward revaluation or a devaluation in your asset. And for devaluations, we know that the first time accounting entry is that you debit your P&L with 200 and you credit your factory with 200. So upward revaluation goes to revaluation reserve or OCI, or downward revaluation goes into P&L. So what is the total gain to be recognized in other comprehensive income? It should be 700 only. So 700 is the answer. D is your correct answer. All right. Okay. Fern Company holds 40% of the ordinary shares in Burke Company and has investments in subsidiaries. 40% of the ordinary shares in Burke Company means it should be your associate. In the year ended 31st December 20x3, Fern Company, the parent company so to say, sold goods to Burke Company for 240,000, charging a markup of 50%. Burke Company held a quarter of these goods in stock at the year end. Which of the following statements is correct? Now, if you look at this, MCQ number 9, so the goods still in inventory were a quarter of the transaction value. The transaction value was 240,000 pounds, and the A company still holds a quarter of these goods with with themselves. So 240,000 into 1 divided by 4, this is 25% or a quarter. This is 60,000 worth of inventory. Now, if you were to calculate the unrealized profit portion, that would have been 60,000. And then there is the markup case. Then there is the markup case with a markup of 50%. So in the case of markup, you do divided by 150 multiplied by 50 to calculate the unrealized profit, which is $20,000. Yeah. Now you need to tell which of the following statements is correct considering $20,000. But still, share of unrealized profit. Yeah, this is an associate case. So you need to work on the share of unrealized profit. 20,000, and what was our holding? It was 40%, so 0.4. The relevant figure, my friends, is 8,000, and you should be only considering any of the following options, which have 8,000 in it. So either the option can be B or the option can be C. A credit entry of 8,000 is made to inventory to reduce the carrying amount. Now, inventories are not consolidated. Inventories are not consolidated if you are following equity method accounting as defined under IAS 28 for dealing with your associates. An associate is not consolidated with you, so no impact on the inventory's carrying value. The unrealized profit of 8,000 is credited to carrying amount of the investment in Berg company, and this is the correct answer. Yeah, this is the correct answer. The answer should be C. A or D could not have been the answer just because of the fact that $12,000 were not matching our value. Let's move forward. Which of the following statements relating to government grants is correct? A grant related to income is recognized immediately in statement of profit or loss when it is received. False. A grant related to income is recognized based on the same pattern. The cost is incurred to meet the conditions attached to the grant. Yeah. Or, the recognition condition is whenever the grant becomes receivable, not when received, whenever the grant becomes receivable. So this is not the correct option. Grant related to assets should always be recognized as deferred income. It's written that it should always be recognized as deferred income. I have a bit of doubt in this. You see, it's not the requirement that it should always be recognized as deferred income. The methodology is that grants related to assets shall be recognized in income in the same pattern in which the assets are being in the same manner in which benefits from assets come, in the same manner your assets are depreciated. So I have a doubt that it says that always be recognized as deferred income. I have a doubt within this. The repayment of government grants recognized as deferred income never impacts the statement of profit or loss. That is false. If the repayment amount is higher than the deferred income that you have, the balancing value will go into P&L. You remember, na? While we studied the cases of repayment of government grants in our classrooms, we studied two cases. One case was when you were repaying the whole amount of grant at a later date because you did not meet the secondary condition. You were repaying the whole amount, but the deferred income liability that you had in books was relatively less than the amount that you were going to pay. So the deferred income, for example, was debited by 2,000, but the cash to be paid back to the government was 4,000. The balancing charge goes to P&L. Now they are saying that in the repayment case, nothing goes into the P&L. Nothing goes into the P&L. That is not true. In some cases, something might go into P&L. An interest-free loan provided by a government is accounted for as a government grant. That is true. Yeah, let's move forward. Okay. It says that Pencil company purchased 80% of the Sky's shares on 1st July X5. So parent company, P company, has acquired 80% of S company's shares on 1st July X5. Your year end is 31st December X5. So this is a mid-year acquisition. Every for the year impact needs to be prorated 6/12. At the date of acquisition, goodwill was measured at $60,000, so the goodwill is already available, and the non-controlling interest was measured at fair value. Good. At the acquisition date, Pencil company concluded that property, plant and equipment with a remaining life of 10 years had a fair value of $1.8 million in excess of its carrying amount. Fair value was higher than the carrying amount. So technically we are talking about MCQ number 11. There was an upward fair value adjustment by 1.8 million. Yeah. And this was about a plant which had a remaining life of 10 years, my friends, which had a remaining life of 10 years. So the remaining life was 10 years. Now, why am I writing all of this in the Excel sheet? Because you would have understood that if there was a fair value adjustment by 1.8 million and the remaining life was 10 years, definitely there would have been some excess depreciation. Yeah. So 1.8 million divided by 10 years, the excess depreciation would have been 180,000. Yeah. But you need for this year, for the period, this would have been, multiplied by 6 divided by 12. So to prorate it. 90,000 is the relevant number. 90,000 is the relevant number. Yeah, done. It says that Sky did not incorporate this fair value adjustment in its individual financial statements. We already know that in your individual financial statements, none of the upward fair value adjustments are adjusted. The upward fair value adjustments relate to the consolidated financial statements and not the individual financial statements. We already know about that. On 31st December X5, goodwill was tested for impairment and found to be fully impaired. The goodwill was fully impaired. Your goodwill was $60,000 and it was fully impaired. Yeah. So if the goodwill was fully impaired, impairment of goodwill, what would be the accounting entry for impairment of goodwill? Goodwill credit 60,000 and CR and NCI debit. You see, it was written in the question that the non-controlling interest was measured at full fair value. Now, this means that they were following the full goodwill method. And if there is full goodwill method, the impact of impairment goes to both parties proportionately. So it would have been, CR and NCI. And the amounts would have been 80% holding for us. So 80% would have gone to CR and the remaining 20% would have gone into NCI. Just discussing this with you. For the year ended 31st December X5, Sky reported a profit. Sky means your subsidiary reported a profit of $1.2 million for the year ended. Remember, for the year ended. Now, your examiner is asking you, what is the pencil group's profit for the year ended 31st December X5 that is attributable to your NCI? That is attributable to your NCI. What is the profit for the period which is attributable to NCI? No worries. We'll just calculate profit attributable to NCI in this case. Now, the format is you take S companies post PAT. Now, S companies post PAT, Sky reported a full year profit of $1.2 million. So the post PAT would have been 6 by 12 since it was a mid-year acquisition. So 1.2 million multiplied by 6 by 12, 600,000. Yeah. Right. Then you would subtract any specific adjustment which is related to NCI. Yeah. Which affects both parties. First of all, there was an impairment of goodwill. Yeah. Then if there is any other adjustment which impacts both parties, it was excess depreciation. So the impairment of goodwill was $60,000. I'll write it with a minus sign. And the excess depreciation for the period was $90,000. So S companies post adjusted PAT would have been the net amount, which is 450,000. Yeah. And how much would NCI get with this? NCI would get 20% of this value, which is 90,000. So the profit attributable to NCI, would have been 90,000. Your answer should be C in this case. Yeah. Let's move forward. Much of consolidation has come into this mock examination within MCQs. I just wonder what will come into the CRQs. Gamer has a 70% owned subsidiary, again a consolidation MCQ. Console company sold goods to Gamer. This is an S2P transaction for $360,000 with a markup of 25% on cost during the year ended 30th June X5. So this is an S2P transaction. The full year transaction was $360,000 with a markup of 25%. 1/3 of these goods remained unsold on 30th June X5. What is the debit adjustment to be made to group retained earnings to reflect the unrealized profit in inventory? Very easy. Yeah. So just 1/3 of these goods remain, right? So this is MCQ number 12, my friends. The total transaction value for the year was 360,000. Yeah. Still in inventory was 1/3 of the total value. So it should be 120,000. Yeah. The unrealized profit being calculated according to a markup scenario would have been take 120,000 divided by 125, yeah, 25% markup, and multiply it by 25 to get the profit percentage. This is 24,000. So what is the debit adjustment being made to group retained earnings? This group retained earning percentage should be, 70% should go into group retained earning and 30% should go into NCI. So the accounting entry would have been group inventory credit. Yeah, 24,000, this would have been a credit. CR and NCI would have been debited. 70% would have gone to CR, whereas the remaining would have gone to NCI. Now the CR adjustment would be 16,800. So your answer should be B in this case. Yep. Let's move forward. All right. Nile company sold a machine to European company and agreed to invoice in euros. This MCQ relates to IS 21. Nile company sold a machine to European company. Nile company has sold something to European company and agreed to invoice in euros. So Nile company would be receiving money in euros. The sale was made on 1st May 20x2. I'll just write this down. This is MCQ number 13. The sale was made on 1st May x2. The money to be received is in euros for 11.88 million euros. 11.88 million euros. So 11.88 euros. Remember, these are euros. Yeah. Half of the outstanding balance was received on 1st June x2. Now this is a very important point. Your year end is 30th June x2 and some amount, at least half of the outstanding balance, was received on 1st January x2. Yeah. So if half of the balance was received on 1st January x2, 1st June x2, half of the 11.88 million euro would have been, I would say 5.94 million euros. Yeah, right. First of all, let me just, bring you back a bit. Nile company sold some goods to a company in Europe for 11.88 million euros. Yeah. There are exchange rates given against a dollar. It's very easy to presume that our currency is the dollar, whereas we have sold a machine in euros. Now we sold a machine for 11.88 million euros, but we need to recognize an accounting entry on 1st May x2. This is the transaction date, and this transaction should be recognized in dollars. Transaction should be recognized in our books in dollars. Yeah. If you look at the exchange rate at this date, the exchange rate applicable at this date, was 0.90 euros to $1. 0.90 euros to $1. I just copy pasted it. Yeah. So each dollar is worth 0.9 euros. Each dollar is worth 0.9 euros. That means euros are less, dollars are more. Euros are less and dollars are more. If euros are less and dollars are more, what should you be doing in order to convert these 11.88 million euros into dollars? How to convert? Conversion should have been 11.88 million euros divided by 0.90. If you have studied F9, you must be knowing that this is an indirect quote written. Foreign currency over local currency. This is an indirect quote and the rule of translation is division. Even if you haven't studied F9 or FM, it's part of common sense. Now, if someone was to say that I will multiply 11.88 million euros with a rate of euros to $1, with a rate of 0.9 million euros to $1, you are just multiplying, my friends, euros with euros. If you are just multiplying euros with euros, then you will get a euro square. Now, the only method to calculate dollars should have been that you take 11.8 million euros and divide it by 0.9 million euros. The euro signs would get cancelled with each other. The euro signs would get cancelled with each other, and then you'll have dollars. So the rule of translation should have been division. And it's more of common sense. It's more of common sense, nothing else. And I just told you the third justification should be, I just told you the exchange rate depicts the fact that less euros means more dollars. Less euros means more dollar. Now, if you have an exchange rate of 0.90 and you multiply 11.88 with 0.90, you will get less dollars. The rule, if you look at this exchange rate, the rule was less euros and dollars are more. So the answer should be, when you're converting euros into dollars, the answer should be more. And you can only get an answer of more if you divide 11.88 by 0.90. Otherwise, you won't get more dollars against euros. Yeah. So we have converted, euros to dollars. Convert to dollars. We have a value of 13.20. The accounting entry would have been receivables debit 13.20 and machine or sales would have been credited by 13.2 million. Yeah, this would have been the accounting entry. Now what happens on 1st June X2? I'll come back to the point. You recognized a transaction in the amount of dollars of 13.2. On 1st June X2, just before the accounting year end, you at least received half of the amounts. You received 5.94 million euros, but the exchange rate prevailing on that date was, exchange rate prevailing on 1st June X2 was 0.80 euros to $1. This is the exchange rate that you see. Yeah. Now, if you convert to dollars, if you convert this amount to dollars on 1st June X2, 5.940 divided by 0.80, you would have got 7.43. 7.43. Just imagine what your books would look like. Receivables, and I'm just taking half of the receivables to make a like with like comparison, since you have only received half of the amount from your from your customer. Half of the receivable, half of it. You recognized a receivable of 13.2 and the half of it would have been 6.66. Amount received on 1st June X2 against half of the receivable would have been 7.43. Would have been 7.43. Yeah. And this means that you would have had a realized gain, realized exchange gain on this transaction, which was 7.43 minus 6.6. Against a receivable of 6.6, you have received 7.43 because the exchange rate moved from 0.90 to 0.08. Therefore, you have received a higher amount and you have received an exchange gain of 0.83 million. This is an exchange gain of 0.83 million. And this is almost, this is just the half of it. On 1st June X2. It says, and the rest is due on 1st September 20X2. Now, my friends, if you have studied IS 21 pretty clearly, it goes on to discuss the impact or the accounting for monetary items. You see, a receivable is a monetary item. And for all monetary items, you need to retranslate your monetary items at the closing date exchange rate. And therefore, half of the remaining receivable you should be revalidating or retranslating at the year end, which is 30th June X2. On 30th June X2, the remaining receivable in your books would have been 13.2 divided by 2, that is the half, 6.6. You need to retranslate or revalue your receivable, which is a monetary item. Yeah. How do you do that? What is the exchange rate on year end? 0.88 to $1. You have a remaining receivable of 6.60, and you need to rather in euros, it would be 5.94 euros remaining, and you need to convert this into dollars. So this would be divided by 0.88, 6.75. Again, you have a unrealized exchange gain just by revaluing your monetary items. And therefore, if I were to answer what is the total exchange gain, during the year, this would have been the sum of both 0.83 plus 0.15. The total of these should be, my friends, 0.98 million. Your answer should be, what is the exchange gain in recognized financial statements of 30th June? Let me just do it in full values. This is 975,000. Yeah, the full values, because there is no thousands or millions given here. I've just written my answer in full values, 975,000. Now, this is something, if you haven't studied IAS 21, pretty clearly, you would have struggled in this MCQ. You would have literally struggled in this MCQ, and most likely, since this was a blank MCQ, many of the students who would have not studied IAS 21 pretty clearly, they would have left this MCQ. You would have lost 2 marks easily, and maximum you would have got 98 marks in your exam. Not worth it. You should get 100 marks in this exam. Yeah. Let's move forward. Much of time spent on this MCQ, but saving a lot of time on the other MCQs. Which of the following are correct according to IAS 33, earnings per share? A potential ordinary share is a financial instrument or other contract that may entitle its holder to ordinary shares. Yes. A potential share is a share which is to be issued in future, and it will entitle the holder of that particular option to shares. Just like convertible loan notes, the holder of the convertible loan notes is entitled to get future shares. Yeah, this is true. Dilution is an increase in earnings per share or decrease in loss per share, assuming the potential ordinary shares are converted. No, a diluted EPS is reported when it decreases. A diluted earnings per share is an earnings per share which decreases moving forward when shares are eventually converted. If your diluted EPS is higher than your basic EPS, then you say it is anti-dilutive and you do not report diluted EPS. A diluted EPS is less than your basic EPS, so it decreases rather than the word increases. It decreases. This is false. Where there is a bonus issue in current period, the basic EPS of the previous period is adjusted retrospectively when presented as a comparative. True. So 1 and 3 are correct answers. We have done 14 MCQs till now. The last MCQ after that, our section A is complete. Which of the following events which occur after the reporting date of a company but before the financial statements are authorized for issue is an adjusting event in accordance with IAS 10. So you need to find out which of the following are basically an adjusting event. Now, the first MCQ, an announcement by the company of plan to discontinue an operation. Discontinued operation, if they are highlighted after the reporting date but before the date of authorization, it is always a non-adjusting event. The implementation of a major restructuring plan, if identified after the reporting date, but even before the authorization date, it is always a non-adjusting event. A change in tax rate announced after the reporting date, but affecting the current tax liability, it is also a non-adjusting event. If the tax rate becomes to be known post the reporting date, it is not an adjusting event. It is a non-adjusting event until and unless it creates a going concern issue. Obviously, the determination of the sales proceed of an item of plant sold before the year end. If an item of plant was contracted to be sold before the year end, just the sales proceed was finalized after the reporting date, then you must have known about the disposal of this particular asset at the end of the reporting period, and therefore this is an adjusting event. You had substantial evidence to suggest that the asset will eventually be sold because it was already contracted within the year end, just the sales price was agreed after the reporting date. This is an adjusting event. This is an adjusting event. This is an adjusting event, and we have completed our section A. All right, so now let's move on to section number B. Section number B is all about OTQs, and let us now focus on OTQs. Every OTQ will have, or an MTQ will have 5 MCQs, and we'll start attempting that. On 1st July 2008, PIPCO acquired the following investments in Solars Company and Aroma Company. So on 1st July X8, where your year end is 30th June X9. So when your examiner says 1st July X8, this is the start of the year. You have acquired investments in 2 companies. One is Solar Company and the other one is Aroma Company. Yeah. It says that 11.2 million equity shares in Solars by an exchange of 1 share in PIPCO for every 2 shares in Solars. First of all, you have acquired Solar Company's shares. And when you acquired Solar Company's shares, you paid them in the form of shares consideration. 1 share for every 2 shares acquired in Solar. And you acquired shares of, you acquired 11.2 million shares in Solar Company. By the way, if you come down, you have been given the extracts of summarized draft financial statements of the 2 companies. If you look at the Solar's SOFP, they had an equity share capital of 16,000 with a par value of $1 each. That means that they have 16,000 shares. Solar's company had 16,000 shares. We acquired 11.2 million shares. That is 11,200 shares. That means our percentage holding would have been 11,200 divided by 16,000. Our percentage holding would be 70%. Just to give you a fair bit of idea, holding is 70%. Now we made a shares consideration. Let us just first write down shares consideration. Now the shares consideration was supposed to be like the number of shares that you have acquired. You have offered one new share of your own company against their 2 shares. Now we acquired 11,200 shares. We can do multiply by 1 divided by 2, and then it says that the market price of each PIPCO company share at the date of acquisition was $5. So each share that we gave of our own had the value of $5. That means that the shares consideration would be $28,000. Yeah. Got it? Done. It says that plus $5.4 million in cash, which was to be paid on 30th June X9. Now you have acquired the company on 1st July X8, but you will pay some amount of cash after 1 year. This is deferred consideration. Yeah. And you calculate the present value of deferred consideration, recognize that as an investment, and then you recognize unwinding of discount as well. So deferred consideration, it says that The market price of each solar shares was 2.25. S company's shares at a market price of 2.25. The cost of capital of Pipco company was 8% per year. Now, cost of capital has been given as 8%. Therefore, you can calculate the present value of $5.4 million deferred consideration. $5.4 million or 5,400 in thousands was the deferred consideration. You can calculate the present value of this just by multiplying it with the discount factor 1 divided by 1 plus R, which is 0.08. Yeah. Raised to the power 1, and this is 5,000. So the total consideration you would say 28,000 plus 5,000. The total consideration is 33,000. Yeah, we have read here till now. Then it's written that 40% of the equity shares of Aroma at a cost of 6.30 per shares in cash. Aroma was an easy acquisition. It was an associate acquisition. Please note this down. It was an associate in which you acquired their 40% shares for 6.30 cash. Now you have acquired 40% shares in Aroma. Aroma had a share capital of 18,000 with a par value of $1. Let me just write it down. Aroma company, they had shares of 18,000 and we acquired 40% of Aroma company's shares. So 18,000 into 40% means 18,000 into 40% means we acquired 7,200. We acquired 7,200 shares. And we acquired these shares on a cash basis with a value of 6.3. So cash consideration in the case of Aroma, which is an associate for us, it was 6.3 into 7,200 shares that we acquired, 45360. Yeah. Okay. Only the cash consideration of the above investment has been recorded by Pipco company. Pipco company has only recorded cash consideration. Nothing else was reported. Then you have S company's balance sheet. They had a retained earning by the year end of the 24,000 and 46,000 respectively. Sorry, at 30th June X8 means it is the opening value. Then profit for the year ended 30th June X9 was 11,600 and 22,000. Can we calculate pre-acquisition reserves for S company, that is solar company? Can we calculate pre-acquisition reserves? Yeah, because you would have had share capital at the report at the acquisition date. I'll just write it down. Pre-acquisition reserves of S company or solar company. Now, what would you have had in your pre-acquisition reserve? Share capital. You remember that share capital does not change. So share capital was supposed to be 16,000. Then what about the retained earnings at the acquisition date? You acquired the other company. You acquired the other company on 1st July X8, which is the start of the year. So at the acquisition date, solar company would have had a retained earning of 24,000. Don't you agree? This is the 30th June X8 balance. So you would have had the retained earnings of 24,000 at the acquisition date. Rest is all post-acquisition. Retained earnings of 24,000. And here you have it. And rest is all post-acquisition. Okay. It says that at the date of acquisition, solar had a contingent liability estimated to have a fair value of 78,000. The fair value changed by 82,000 by the year end. Remember that according to the rules of consolidation, when you acquire a subsidiary, everything is valued at full fair value. So you need to recognize the fair value of this contingent liability as well at 78,000. When a liability is recognized, it adversely affects your net assets. So it is a negative adjustment. Contingent liability means that your liabilities increase and therefore your net assets decrease. Net assets are assets minus liabilities. So when your minus liabilities increase, net assets decrease. Minus 78,000 So the net assets would have been 16 plus 24, net 78,000. Yeah. All right. So I just made a mistake and you could have done the same. You see, all of these numbers are in thousands. All of these numbers are in thousands, but this fair value is not written in thousand. It is full 78,000. So if we were to, if we were solving the whole question in thousands, this should have been 78. Yeah. So here we go. Yeah. Moving forward. At the date of acquisition, Solars had an agreement to provide goods and services to one of its major customers for a further 8 years. The directors of Pipco company estimate that the customer-based contract has a fair value of $4 million. If you have a customer-based contract in front of you, you need to recognize this customer base as an intangible assets at the reporting date. So this 4,000 is also an upward fair value adjustment of an intangible asset. It is simply a customer base. This is 4 million or 4,000. So the correct answer should be, you have a net assets of 43922. 43922. Yeah. Now your examiner says, when calculating goodwill on the acquisition of Solars, what is the total consideration transferred? We have read the whole scenario. The first MCQ is, when calculating goodwill on the acquisition date of Solars, what is the total consideration transferred? And you need to write the answer in millions. So the total consideration that we saw was 33,000, or in millions it would be 33. The answer should be 33. Moving forward. At what amount should the contingent liability of Solars be included in the calculation of goodwill? It should be 78,000. It should be 78,000. We just read about it, 78,000. Yeah, we did it here as well in our format, 78,000. Yeah. Then moving on. Which statement regarding the customer-based contract is correct? Customer-based contract, by the way, is an intangible asset and it should be recognized on fair value at the date of acquisition, because according to IFRS 3 business combinations, whenever you acquire a subsidiary, you should account it for under the acquisition method accounting. And according to acquisition method accounting, the acquisition must be based on full fair value basis. It is internally generated and should not be recognized in the consolidated financial statements. No, from a consolidated point of view, it is an acquired intangible asset and therefore it should be recognized as an intangible asset. This is not true. Not true. It should be recognized as an intangible asset in both the separate financial statements of Solars and the consolidated financial statements. Wrong. From an individual financial statements point of view, it is an intangible asset internally generated. So it should not be recognized as an intangible asset according to IAS 38 in the individual financial statements of Solar company. But yes, from a consolidated point of view, when parent company acquires subsidiary company, it becomes an acquired intangible asset. It should only be recognized in the consolidated financial statements. So this is not true again. It should be recognized as an intangible asset in the consolidated financial statements and is not amortized. You see, you have a remaining life of 8 years. It was mentioned in the scenario that it has a remaining life of 8 years. If it has a remaining life of 8 years, you should amortize it. So only this portion is incorrect. Yeah. It should be recognized as an intangible asset in the consolidated financial statements and amortized over 8 years. This is absolutely the correct answer. I would highlight this green and therefore tick on this. This is the correct answer. Moving forward. What is the carrying amount of investment in Aroma in the consolidated financial statements as at 30th June X9? X9. What is the carrying amount of investment in Aroma? So we acquired Aroma, 40% of the shares we acquired in Aroma, at 6.3, and the total cash consideration that we had was 45360. We need to follow the equity method accounting. And the equity method accounting would be as follows. We will start with cost of investment. Cost of investment is 45360. We will add any share of profit and will less any impairment, or we will less any dividends given during the year. And then we'll have carrying value of investment in a company. Yeah, this is the equity method accounting. Cost of investment is 45360. If you talk about the share of profit, the Aroma company has earned full year profit of 22,000. This is all post acquisition, since we acquired the other companies on at the first date of year. Yeah, 1st July exit was the first date of year. So share of profit, you need to calculate it as 22,000, yeah, and you multiply it by 40%. So 8,800 should be the answer. Yeah, 8,800 should be the answer. There are no impairments, no dividend mentioned in the question. So your closing answer should be 54160. It should be 54.16 million. 54.16 million should be your answer. Yeah. Moving forward, the last MCQ for this MTQ. It says that when Pipco company, a textile company, prepare its group financial statements, which of the following companies should be consolidated? Your subsidiaries should be consolidated. Any company on which you have control should be consolidated. Alpha company. Pipco company currently owns 40% of the share capital of Alpha company. Now, if you have 40% shares in another company, most likely it will be an associate. It will not be a subsidiary, so you should not be consolidating it. However, it says which is also a textile company and holds options to purchase another 20% shares, which it can exercise immediately. Now, this is related to potential voting rights. And if you have potential voting rights which are currently exercisable and are in the money, you should consider those potential voting rights while you are determining control. I believe that you have control in this company and you should be consolidating this one as well. Then Beta company. Pipco company owns 55% of Beta company. Now, if you have 55% shareholding in another company, most likely you would have got control in that company and therefore you should be consolidating it. Beta company manufactures agricultural machinery. That is fine. Whatever business does the subsidiary have, this is none of our concern. But as long as we have control over the company, we should be consolidating it. So I believe 1 and 2 should be correct. Gamma company. Pipco company owns 80% of Gamma company. 80% means control is there. Gamma company is a garment manufacturing company, but it is a loss making, and Pipco company is considering selling it in the near future. You are considering it selling in the near future. Still you have control over the company and therefore you should be consolidating it. For my sake, the answer should be 1, 2 and 3. Done. All right. So now moving on to, MTQ number 2. It says the following information relates to questions 21 till 25. Then it says that Anushi company is a pharmaceutical company. It is preparing its financial statements for the year ended 31st March 20x9. So this is your accounting year end, my friends. It says that 2 cases are there, assets held for sale and project X. I'll read both cases at once and then I'll start solving the MCQs. For me, it's easier. Well, you can do, whichever format you're comfortable with. Assets held for sale, IFRS 5. Anushi company discontinued a product line during the year ended 31st March 20x9. Now, if you are discontinuing a specific product line or a geographical area of business, this comes within the purview of discontinued operations. Now, you should be giving a separate disclosure for it. As a result, plant became surplus to the requirements on 1st of October X8. Mid of the year, the plant became surplus to your requirements. The plant was immediately offered for sale at 91,000, which was considered to be your fair value. Now you are going towards a non-current asset being held for sale. You had a plant which became surplus to your requirements, and therefore you were willing to sell it. You decided that the selling price would be 91,000 and it is closer to the fair value prevailing at that time. Now remember, when I used to teach you IFRS 5, I used to give you 5 conditions to focus on. Literally, there are 4 conditions, I call them 5. Those 5 conditions were: when your assets carrying, when the asset is expected to be, the 5 conditions were: when it is, when the sale of asset is highly probable, when your asset is being marketed at a price which is reasonable in relation to fair value of the asset, when the asset is expected to be sold within 1 year, when there are no plans that the plan to sell your asset may be changed or withdrawn. So there were certain conditions that we used to follow while classifying our non-current asset as held for sale. Selling costs are estimated to be $5,000. Perfect. The plant had a carrying amount of $96,000 at 1st April exit. This is the start of the year. So let me just go to MTQ number 2 working, and this will be MCQ number 1. I'll write down a bit of things now. The plant had a carrying amount of 96,000 at the start of the year. So carrying value on 1st April 20x8 was 96,000. Now you need to note this down, my friends. 96,000 was the carrying value at the start of the year, whereas we classified this to be a non-current asset for sale on 1st of October x8. That is, if you think about it, this is technically, I would say, that April, May, June, July, August, September, 6 months after. So what would have been the depreciation 6 months after? That is my major concern right now. It was being depreciated at a balance on reducing balance basis at a rate of 12% per annum. So the depreciation for 6 months would have been 96,000 into 12% into 6 by 12. And I'll put a minus sign with it. It is 12%, not 0.12. 5760. So the carrying value on 1st October 20x8 would have been 96,000 net of 5760, 90240. At the date this plant was supposed to be classified as a held for sale, its fair value less cost to sell would have been 91,000 with a selling cost of 5,000. So I would say fair value less cost to sell would have been 91,000. 91,000 minus 5,000. So any potential impairment. You remember now, whenever we classify our non-current asset as held for sale, we need to perform impairment testing, and an impairment testing is performed while taking the lower of carrying value and fair value less cost to sell. There will be no value in use because you are not going to continue using the asset. That is the whole concept of non-current asset being classified as held for sale. So the impairment would have been, I'm just calculating, I don't know what is the real question behind it, but the impairment would have been 4240. Moving on, Project X. Anushil company commenced Project X, a research and development project on 1st April X8, which is the start of the year. And total cost of $45 million accrued evenly over the period to 31st December X8. So from 1st April X8, you incurred $45 million over the period of 9 months to 31st December X8. So Project X, we are talking about expenditure per month would have been you spend $45,000 over a period of 9 months. 1st April X8 till 31st December X8 means 9 months. 9 months. So for each of the 9 months, you spend a total of $45 million. That means for each of the 9 months, you spend $5,000 per month on average. It says that it accrued evenly throughout the period. on 30th June X8, on 30th June X8, that is April, May, June, 3 months after the start of this expenditure, 3 months after the start of this expenditure, the directors were confident that the project met the capitalization criteria under IAS 38. So the capitalization criteria, what was met on 30th June 20X8. Therefore, first 3 months, the criteria was not met. The first 3 months, the criteria was not met. So you were only doing research or development while the criteria was not met. The first 3 months goes to P&L. And maybe the last 6 months, to be capitalized. Yeah, the last 6 months are logically supposed to be capitalized. Yeah. So 5,000 per month expenditure, multiply by 3, you get $15,000 for your P&L, and rest, $5,000 into the remaining 6 months. 6 months, this should have been capitalized as an development asset. Yeah. Examiner says the project was completed and began to generate revenue from 1st January X9. It is estimated that the project will have revenue for 5 years. This is given to you so that you can calculate amortization. Amortization would have only been calculated from 1st January X9 till the year end. Your year end was 31st March X9. So only 3 months worth of amortization should be calculated. $30,000 was the capitalization amount. We will divide it by 5, multiply it by 3 by 12, and there you have it. For this year, you will have an amortization value of 1,500. Yeah, so this will also go into P&L. So 2 things go into P&L, and the rest is capitalized. Yeah. All done. We have read the whole question. Now let's go through the requirements. Identify which of the following is not a criterion for classification of an asset as held for sale. An active program to locate a buyer and complete the plan must have been initiated. This is the requirement. You cannot say. Remember, the sale must be highly probable. You should be actively looking for the buyer at a price which is reasonable in relation to fair value of the asset. So logically, this is a requirement of IFRS 5. It asks you what is not a criterion. This cannot be the answer. The sale should be expected to take place within 1 year from the end of the current accounting period. False. It is 1 year from the date of classification, not 1 year from the reporting date. This should be the answer. The asset must be available for immediate sale in its present location and condition. This is one of the requirements. The sale must be highly probable. This is one of the requirements. So definitely B should be the answer because this is not the requirement under IFRS 5. Moving forward. It says calculate the impairment loss to be recognized when the plant is classified as held for sale. Luckily, we had already done it. This is 4240. 4240. Yeah. I would write 4240. This is the answer. I had already done it. Then, which 2 of the following statements correctly reflect requirements of IAS 38 intangible assets? Which 2 of the following statements you need to select under this? Intangible assets with a finite useful life should be amortized over that life, and intangible assets with an indefinite useful life should not be amortized. True. Intangible assets should not be amortized, but instead should be reviewed for impairment annually. No. Intangible assets which have a finite life should be amortized. Yeah, and which do not have which do not have finite life, as intangible assets which have indefinite life, they should be annually reviewed for impairment. The amortization period and method applied to intangible assets should be reviewed at least annually. True. Intangible assets should be amortized to reflect the pattern of revenue that they will generate. False. This is not a requirement. Yeah. So 1 and 3 should be the correct answer. Moving forward. In accordance with IAS 38 intangible assets, what is the amount to be charged in P&L for the year ended 31st March X9 in respect of project X? So basically your examiner is asking you what will go into P&L for project X. 15,000 and 1,500. 15,000 total into P&L. 15,000 plus 1,500, this should be 16,500 or 16.5 million. This is the right answer. Let's move forward. The last MCQ in this MTQ, which of the following would result in recognition of an asset in an issue statement of financial position? Which of the following shall be considered as an intangible asset? Anushi spent $60,000 on an advertising campaign. Remember, advertising expense can never be capitalized as an intangible asset. Never. I'll leave this. I won't even read it further. Anushi purchased the copyright and film rights to the next book to be written by a famous author for 45,000 on 1st March X9. Your year end is 31st March X9. You bought copyright of a particular writer for a particular book, and that should be treated as an intangible asset. True. Anushi is taking legal action against a contractor for faulty work. Its legal team is advised that it is probable that Anushi will receive 210,000 in settlement for its claim. Should it be recognized as an intangible asset? False. Any claim that is contingent to be received to you, it is a contingent asset treated under IAS 37, not under IAS 38. This cannot be the answer. Anushi has developed a brand name. The directors believe that the brand name has a value of 135,000. Very good that you have developed a brand name, but still it is an internally developed brand name. It is part of your internally generated goodwill, and therefore it cannot be recognized as an intangible asset. Again, D cannot be the answer. Only B can be the answer. Okay, done. Now we have completed this MTQ as well. All right. So now in this, the third MTQ, the following scenario relates to questions 26 till 30. Nashna company manufactures cycling equipment. The following relates to the year ended 30th June X5. Yeah, 30th June X5 is your year end. Inventory. At 30th June X5, it has a number of items of product A in inventory which cost $68,000 to manufacture. So you have got some inventory which is worth $68,000. These were manufactured to meet a customer order at a total agreed price of $96,000. Due to recent technological advances, the current cost of manufacturing such products is estimated to be $31,000. It is expected to be $31,000 current cost. Yeah, so advancement in technologies had brought you the value to be 31,000. You see, let me just explain you this MCQ. MCQ number 1. So you have some inventory with you which is worth 68,000. Now this inventory is already contracted. It's already contracted to be sold for 96,000. Yeah. Now due to technological advancements, you can, manufacture the same inventory in 31,000. How should your inventory be valued? Yeah, this is the question. You see, as per IAS 2, inventories are recorded at lower of cost or NRV. Now, NRV is calculated as estimated selling price minus cost to sell minus cost to complete. Now, you have a particular item of inventory in your books which has a cost of 68,000. And if you talk about your NRV, although it is true that if we were to create the same type of inventory today, we could have created it for very less. But we have already had a customer for this type of inventory and a contract has been made, and the estimated selling price under that contract is 96,000. Minus cost to sell minus cost to complete. Assume it net. So Although we can manufacture this inventory at a very lower cost nowadays, but should we be writing off our own inventory at this moment in time? I don't think so. If we have a ready buyer available for it, if that buyer is willing to purchase as 96,000, then there is no write down on this particular item of inventory. There is no write down on this particular item of inventory. That is true that as per IS2, you should be recognizing it as at lower off, and your lower off should be 68,000. You see, technological advancements happen throughout the year. It's nothing to be surprised of. So technological advancements happen, costs do come down due to efficiency and something, but that does not mean you should be writing down your inventories one day or the other. You have a value which is 68,000, less value of 68,000, and should be recognizing that. Yeah. So, by the way, at what amount is the closing inventory of product A, including in National's statement of financial position? I would say 68,000. Yeah, that is the lower of. Okay, we have another case, sale and repurchase. Why don't I? Yeah, okay. Sale and repurchase. In May 20x5, National Company entered into a contract for the sale of inventory of product B to Corona Company for 700,000. Yeah, National Company received 700,000 on 30th June X5 and delivered the goods on 4th July X5. National Company sold the goods to Corona Company against 700,000. National Company sold product B to Corona Company for 700,000. I'll repeat. National Company sold the goods to Corona Company for 700,000. If these goods were sold to Corona Company should have picked up these goods and should have went away. Corona Company paid $700,000 to us. We sold our inventory to them. They should have gone with our inventory. But it says that National Company received 700,000. We even received 700,000. And we delivered the goods on 4th of July X5. National Company has the right to repurchase the goods on 840,000. Oh. This is a sales and repurchase agreement. We have discussed this many a times in our normal classes. Sales and repurchase agreement. This is not a satisfaction of performance obligation. No revenue can be recognized against it. Rather, the cash received of 700,000 should be treated as a liability. It is a collateralized loan that you have taken. So the accounting entry under MCQ number 2 should have been that you should have debited your bank by 700,000 and created a loan liability of 700,000. Yeah. And the difference of 700,000 and 840,000 should have been recognized as interest expense over the future course. Yeah. This is a sales and repurchase transaction, nothing else. It is a collateralized loan. Yeah, because you can repurchase your assets again. Lease arrangement. National Company entered into a 8-year lease agreement on 1st July X4, which is the start of the year, by the way, for an item of plant. The lease requires annual payments of 750,000 in arrears. The present value of future lease payments on 1st July X4 discounted at the rate of 6% was 4,657,500. Yeah. So everything is given with regards to the lease. National Company paid lease arrangement fees of 37,500. The cost to dismantle the plant at the end of the lease term are 320,000 and the present value of these are 200,640. This is a proper lease question, I would say. MCQ number 3, I guess. Leases. Now in leases, we have studied how to value your right to use asset and your PVMLP. The present value of minimum lease payments has already been provided to you as 4,657,500. 4,657,500. Whereas when you talk about your right to use asset, the value of your right to use asset should be that it should be 4,657,500, the present value of minimum lease payments, plus you should be adding 37,500 as a transaction cost, plus you should be capitalizing the present value of future compulsory disposal cost as well, which is 200,640. So the right to value your asset, right to use asset should be 4,895,640, 4,895,640. If I were to account for this transaction, the lease amortization schedule would have been prepared as follows. Do you remember the format? Date, rentals, interest, decrease in FLO, and balance FLO. The transaction would start from year 0. I would write year 0 or 1st July X4. The rentals would have been, it is written the rentals are 750,000. The rentals would have been 750,000. 467,500 should have been multiplied by 6% to calculate the interest component. Yeah. This would have been the decrease in FLO. Oh, on 1st July X4, our liability would have been 465,500. The next meeting would have been on 30th June X5, which is the year end. We would have paid rentals of 750,000, interest of 7% on the liability amount. Yeah, on the liability amount. The decrease of the principal repayment would have been the difference of rentals and interest. Your balance FLO would have been this 4186950. This would have been your answer. And from a depreciation on RUA point of view, it should have been 4895640. It is an 8-year lease, so you'll divide it by 8. You'll get depreciation of 611,955. 611,955 should have been the depreciation. I hope you understand this solution. It's not very difficult. I'm going a bit faster in this MCQ because I think it's very easy to do. Then contract with a customer. Contract with a customer. National Company entered into a contract with the professional cycling team on 1st February X5 to provide 10 bikes as well as maintenance support services for a period of a year for a total price of 150,000. The contract price is 150,000. Each bike. Okay, first of all, what you need to understand, I might have gone a bit quick, but you need to understand this scenario. Contract with customer. Whenever you think about contract with customer, you get the thinking that this should be related to revenue from contract with customers, IFRS 15. Now, IFRS 15 followed a 5-step approach to recognize revenue. First one was to identify a contract with customer. Then you need to identify performance obligations, then determine transaction price, allocate transaction price, and then recognize the revenue. Now, in this case, you have had a contract with a professional cycling team on 1st February X5, which is, some days before the year end. So 30th June X5 before that, to provide 10 bikes, these are goods, as well as maintenance support services for a period of year. So technically, you have undertaken to supply goods, which are bikes, and a year's maintenance as well. So these are services. Now, my friends, the total contract price, you see, the total contract price is 150,000. Yeah, the total contract price is 150,000. Now, some part of this 150,000 needs to be allocated to bikes, and some part of the 150,000 needs to be allocated to 1 year's maintenance. How will you do that? You will select standalone prices, and you will allocate based on standalone prices. Yeah. So standalone prices are, each bike has a selling price of 150,000. You decided to deliver 10 bikes. So the standalone price for 10 bikes should be 15,000 into 10 bikes, 150,000. And maintenance support services for a year are usually charged at 3,750 per bike. You have 10 bikes to offer. So 3,750 multiplied by 10, this is 37,500. The total amount is supposed to be 157,000 plus 37,500. The proportionate value would be 80 and 20%. Now you need to multiply, you need to apportion this 150,000 of your contract price on the same basis. You need to allocate this 150,000 contract price on the same basis as for standalone price. So you do 80 into 20, 80, 20. Yeah, this is the way you allocate contract prices. Done. Now I'll just start looking at the MCQs now because I've read the whole question. Which statement is correct in relation to product B? Product B, you remember product B? For product B, it was a sale and repurchase agreement. You need to recognize a liability. This is a collateralized loan, not a revenue transaction. So when I look at the potential options, B cannot be the option since it has revenue to be recognized. A contract liability cannot be the answer. Again, a contract liability can only be recognized when there is a revenue. So the option should either be A or C. A financial liability of 700,000 is recognized in National Statement of Financial Position as at 30th June X5. A financial liability of 840,000 is recognized in the financial statements. No, the answer should be A. $700,000 you have received from your collateralized loan partner, and therefore that should be recognized as a loan liability, 700,000. We even did this here. Yeah. Moving forward. What is the total depreciation charge in statement of profit or loss for the year ended 30th June X5? We calculated 611,955. So this should be the answer. We calculated the total depreciation charge. Yeah. Moving forward, what is the carrying amount of non-current lease liability in the statement of financial position? Remember, it's only asking for non-current lease liability only in the statement of financial position at 30th June X5. Whenever your examiner asks you for 1 year ahead, whenever your examiner asks you for a bifurcation of non-current and current portion, you need to solve the question at least 1 year ahead. Yeah. So the rentals would be 750,000. The liability would be 0.06 of this. I'm just solving this question. 4186950 minus decrease in FLO. 368167 should be your non-current liability since it says beyond 1 year. Those who have studied lease easily catch up this solution. 3688167 should be the answer. 3688167 should be the answer. What revenue should be recognized in respect of the contract with cycling team in the year ended 30th June X5? You see, what revenue should be recognized? We are going to deliver bicycles, so $120,000 should be recognized by the year end because we are going to deliver those bicycles. This maintenance contract, this contract was done on 1st February X5, whereas our year end is 30th June X5. So February, March, April, May, June, 5 months of maintenance service revenue should be recognized. Bikes, 5 months maintenance. 30,000 multiplied by 5 divided by 12. So total should be 120,000 plus 12,500. Oh, we don't have any answer like this. What to do? The answer should be 132,500. I'm 110% sure. And I can say to you, I'm very sure 132, this MCQ is wrong. The answer should be 132,500. The answer should be 132,500. I'm 110% sure. There is a typo mistake in this MCQ. Yeah. Go and check the answers. When we complete this exam, we'll go and check the answers. Yeah. The answer should be 132,500. And now we have done all the MTQs. We are done all the MTQs. Yes.